Hello traders, welcome back to the Forex Geek, and in today's video we are going to be talking about a highly effective moving average strategy that can help you take advantage of short-term market movement. Whether you are looking to make quick trades or simply refine your scalping technique, this strategy is designed to give you a clear entry and exit signal using moving averages. So stay with me until the end of this video and you will learn how to set up this strategy effectively for consistent results. First of all, what is a moving average? A moving average are essential tools in forex trading, especially for scalping strategies. A moving average calculates the average price of an asset over a specific period, smoothing out the fluctuation of price and helping out traders identify the trends more easily. For scalpers, we would focus on the exponential moving average, which is the EMA, which gives more weight to the recent price data, making it more responsive to the current market direction or current market condition. The EMA are particularly useful for scalping because they react quickly to price changes, allowing you to spot potential entries and exit points in fast moving markets. When the price crosses above the EMA, it signifies a signal for an uptrend, while when price crosses below could indicate a downtrend and this responsiveness is crucial for scalpers who need a quick decision based short-term price movement. As you can see from the chart, the moment the price is above the EMA, it means that we are in an uptrend, and once it's below, it means we are in a selling or a downtrend. All right, let's see what the strategy is all about. The moving average crossover strategy is a simple yet effective method for identifying potential buy and sell signals in the market. This strategy involves using two exponential moving averages with different periods to spot changes in trend. For example, for this example, we'll be making use of the 10 period EMA and the 20 period EMA. This is what we are going to be making use of. So how does this strategy works? For a buy signal, remember, for a buy signal, when the 10 period moving average crosses above the 20 period moving average, let's look at this setting again. For our style, we can see the 10 period moving average is the blue line, while the 20 moving average is the yellow line, to make it easier for us to understand. So once the 10 period moving average crosses above the 20 period EMA, it signals a potential uptrend. As we can see from this example, once the blue line crosses above the yellow line, it signals buying opportunity, and we should only consider entering buy trades. While for a sell signal, when the 10 period EMA crosses below the 20 period EMA, as you can see from here, when this blue line crosses below the yellow line, it indicates a potential downtrend and signaling only selling opportunities, as we can see from the chart. So how do we implement this strategy effectively? We set up our charts with both EMAs, the 10 and 20 EMA, like we have already done. We wait for a clear crossover to occur. As we can see, there is a clear crossover in this particular area of the market. We enter our chart, we enter our trade based on the direction of the crossover. The crossover was above, so we would enter a buy trade in this area. Always use a stop loss. Remember, when we enter after the crossover and when we see price come to retest the line, we enter in the direction, we enter and put a stop loss. Don't forget to always manage your risks. Place them just below the recent swing low. You can place them in just below the recent swing low for a buy trade and above recent swing high for a sell trade, but I'm using a buy trade for this example. We have to manage our trades by taking our profits based on a standard risk to reward ratio, typically always aiming for 1:2 or 1:3 as the case may be. This is how we manage our trade. Don't forget, it's not only about getting a good entry but about how to manage your trade. That is very important to becoming a successful trader. This strategy works best on shorter time frames like the 15 minutes chart or the 5 minutes chart, which is ideal for scalping. Always ensure that you are trading in alignment with broader market trends to avoid unnecessary risks. So you always analyze your market, your chart from the higher time frame to the lower time frame, just to avoid unnecessary risking of your trading account. Alright traders, we have come to the end of this video. Today we covered the moving average strategy and how we can use the exponential moving average to identify clear entries and exit points in the market. Remember, mastering this strategy requires patience and discipline. So be sure to test it out on a demo account before applying it in a real life market account. If you found this video helpful, do not forget to like the video and subscribe to the channel. Turn on the notification bell so that you wouldn't miss out on any updates. So thank you for tuning in, and until next time, happy trading.